Ask most people why repo trucks are suddenly everywhere, and you'll get the same answer. People are bad with money. They buy cars they can't afford. They miss a payment or two, the bank shows up, end of story. It's a satisfying explanation because it puts the blame on a single moment of poor judgment. And it's almost completely wrong. The real story isn't about one bad decision. It's about a piece of hardware sitting behind your eyes that hasn't been upgraded in about 200,000 years, running headfirst into a financial system that was very specifically engineered to exploit it. Let's start with the hardware. For most of human existence, the single biggest threat to survival wasn't a bad long-term plan. It was starving to death next week. A brain that prioritized get calories now over optimize for a decision that pays off in 7 years wasn't being foolish. It was being correctly calibrated for the environment it evolved in. Economists have a clinical name for this instinct: present bias, or hyperbolic discounting. In plain terms, a reward available today feels disproportionately more valuable than the exact same reward available next month, even when the math says they should feel roughly equal. Ask a person if they'd rather have $100 today or $110 in a month, and a huge number will grab the $100. Ask that same person if they'd rather have $100 in 12 months or $110 in 13, and suddenly almost everyone is willing to wait the extra month. The reward hasn't changed. The distance from right now has. That single quirk of brain wiring is the hidden engine behind nearly every number you're about to hear. Here's the collision. The average new car in the United States now carries a price tag hovering close to $50,000. A brain wired to evaluate, can I survive this week, has no natural machinery for evaluating, can I sustain this specific monthly outflow for the next 6 or 7 years. So the auto industry doesn't sell you the $50,000 number. It sells you the monthly number, because the monthly number is small enough for the ancient part of your brain to accept without triggering alarm. And when even the monthly number gets too large, there's a lever for that too: stretch the loan. A decade ago, a 7-year car loan was a rare, slightly embarrassing outlier. By early 2026, loans of 84 months or longer accounted for close to 23% of all new vehicle financing, more than double the share from 10 years earlier. And 72-month loans now make up over 40% of new car sales on their own. Stretching the term doesn't make the car cheaper. It makes the sting smaller today, in exchange for paying more overall, at a higher interest rate, for far longer. A buyer financing over 84 months is currently paying an average rate more than a full percentage point higher than a buyer on a 72-month term, and over 3.5 points higher than a buyer on a traditional 60-month loan. The caveman brain doesn't see any of that. It sees a payment it can absorb this month, and this month is the only month it's really built to evaluate. This is where the story stops being abstract psychology and starts being math with real consequences. A new vehicle typically loses somewhere around a fifth of its value in its very first year, and roughly half its value within 5 years. A 72 or 84-month loan, by design, pays down the balance slowly in the early years, since most of each payment is going toward interest rather than principal. Put those two curves on the same chart, and you get a gap. For the first several years of a long-term loan, the car is worth less than what's still owed on it. That gap has a name. It's called negative equity, or being underwater. In the first quarter of 2026, roughly 30% of everyone trading in a car toward a new purchase was underwater on the old one, owing an average of just over $7,100 more than the car was worth, the highest first quarter figure ever recorded. That unpaid balance doesn't disappear when the trade happens. It gets folded into the new loan. So the buyer walks out having financed not just their new car, but the invisible leftover debt from the old one stacked on top. Borrowers doing this were financing close to $56,000 on average, about $12,000 more than a typical buyer, pushing monthly payments toward $930, among the highest ever tracked. And a 2024 study from the Consumer Financial Protection Bureau found that people who rolled negative equity into a new loan were more than twice as likely to have that new car repossessed within 2 years, compared with buyers who traded in with equity intact. Notice what's happening here. Nobody made one catastrophic decision. Each individual choice, take the longer term, roll the old balance forward, made the immediate month more survivable. The caveman brain did exactly what it was built to do. The debt just kept compounding quietly in the background the whole time. Not everyone is equally exposed to this trap, and this is where the picture sharpens. Subprime borrowers, generally defined as people with credit scores below roughly 620 at the time they take out the loan, make up only about 17% of all outstanding auto loan accounts. Yet they account for nearly 2/3 of all delinquent ones. As of early 2026, the share of subprime auto loans at least 60 days past due sat around 6.8%, the highest level recorded since data collection began in the early 1990s, a 32-year record. Meanwhile, prime and superprime borrowers, people with strong credit, have barely moved off historically low delinquency levels. This isn't a broad wave hitting every driver equally. It's a narrow, concentrated crisis hitting the group of people who already had the least room to absorb a surprise. Total outstanding auto debt in the US has climbed to roughly $1.69 trillion. Annual repossessions rose about 43% between 2022 and 2024 alone, reaching an estimated 1.73 million vehicles, the highest volume since 2009. Industry forecasters generally expect 2026 to hold near those elevated levels, rather than retreat, because the loans now aging into serious delinquency were mostly originated back in 2022 through 2024, right when vehicle prices, interest rates, and loan terms were all climbing at once. In other words, the pressure you're seeing now was built into loans signed years ago. The repo trucks are simply the delayed echo of decisions made when prices first spiked. Here's the part that makes the picture even stranger. There's an entire category of dealership built specifically around the assumption that a borrower will eventually fall behind. It's called buy here, pay here. Instead of a bank or credit union financing the purchase, the dealership finances it directly, in-house, often to buyers with no credit history at all. Interest rates at these lots can run into the high 20s or beyond, several times the national average, and the vehicles themselves are frequently older, higher mileage cars sold at a steep markup relative to their actual value. Because the lender knows, statistically, that a meaningful share of these loans will go delinquent, a whole layer of technology has grown up around managing that risk. GPS trackers and starter interrupt devices, sometimes called kill switches, are now installed in an estimated 1 out of every 4 subprime auto loans nationwide. Fall behind on a payment, and the lender can remotely disable the ignition, sometimes with only minimal warning. One well-documented case involved a woman in North Carolina whose car was disabled by her lender while she was inside a dialysis appointment she depended on to survive. Several states have since passed laws requiring advance notice, emergency overrides, and disclosure before these devices can be used. But the underlying incentive that created them in the first place, a lender trying to protect itself from a borrower it has already decided is a high risk, hasn't gone anywhere. Even the technology reveals the same underlying logic as the caveman brain, just running on the other side of the transaction. A predator watching a herd doesn't need to understand every individual animal's intentions. It just needs to identify which ones are most likely to falter and stay close enough to react instantly. A GPS-enabled kill switch is a lender doing exactly that. Not trusting the relationship, but engineering a system that can respond the moment risk becomes visible. It would be easy to assume the borrowers are the only ones making short-term decisions with long-term consequences. They aren't. In September 2025, Tricolor Holdings, a Dallas-based subprime auto lender and used car chain built around serving buyers with no social security number or credit history, collapsed into bankruptcy with roughly $1 billion in assets and more than 60,000 outstanding loans on its books. Federal prosecutors later charged its founder and top executives with running what they called a years-long systematic fraud, alleging the company had repeatedly pledged the exact same loan collateral to multiple different lenders at once, and manipulated its own loan data to make delinquent, ineligible accounts appear current and healthy. Banks that had extended credit to Tricolor, including major institutions, absorbed hundreds of millions of dollars in losses when the fraud came to light. As the company was reportedly nearing collapse, its CEO allegedly directed millions of dollars in bonus payments to himself before the doors closed. Tricolor isn't an isolated anomaly. Other subprime auto lenders have hit serious trouble in the same stretch of years. And one of the industry's largest publicly traded players spent mid-2026 working with its own creditors just to stay solvent. The pattern across all of these cases is the same one playing out at the level of individual borrowers, just with more zeros attached. Short-term financial relief, hitting this quarter's numbers, satisfying this month's lenders, keeping the machine running for one more cycle, consistently won out over addressing the structural risk building up underneath. The caveman brain doesn't only live inside people financing a car they can barely afford. It lives inside executives financing a business model that can barely support itself, betting that the reckoning stays a future problem. Put all of this together, and the repossession wave stops looking like a story about irresponsible individuals and starts looking like something much more mechanical. A brain built to weigh today far more heavily than later meets an industry that has learned, in exquisite detail, exactly how to present debt in monthly sized portions, small enough for that brain to accept. Stretch the term, and the sting shrinks further while the total cost grows. Roll old debt into new debt, and the immediate problem vanishes while the underlying gap widens. Extend credit to the borrowers least equipped to absorb a shock, and build surveillance technology to manage the fallout rather than prevent it in the first place. None of these decisions look reckless in the moment they're made. Each one is a small, locally rational choice by a brain doing exactly the job evolution built it to do. It's only when you add them all up, across a $1.69 trillion market, over years of loans quietly aging toward default, that the picture becomes what it actually is. Not a story about bad decisions, but a story about an ancient piece of wiring meeting a financial system precision-built to speak its language. The repo truck on the street outside isn't collecting on one mistake. It's collecting on a mismatch between the brain we have and the economy we built. One monthly payment at a time. If this changed how you think about something you thought you already understood, that's the whole point of this channel. If you enjoyed it, drop a like and subscribe. It genuinely motivates me to keep making videos like this. And if you've got a topic you want broken down this way, drop it in the comments. I read all of them.